Chapter 5. Segregated Fund and Annuity Recommendation. Competency Components. Analyze the available products that meet the client's needs. Implement a recommendation adapted to the client's needs and situation. Competency Subcomponents. Analyze the types of investments that can constitute a segregated fund and that meet the client's needs. Propose a recommendation adapted to the client's needs and situation. 5. Segregated Fund and Annuity Recommendation. When the individual investor profile is complete, the time arrives for the agent to recommend the most appropriate segregated fund and annuity investment. The agent must weigh many factors in developing the recommendation and ensure the client investor understands the rationale underlying the choice or choices presented. Recommendations for groups are also prepared by the agent. This aspect of the agent's role is addressed later in this manual. Regulators have set out guidance to address the fair treatment of customers by agents. Point 29. It encompasses concepts such as ethical behavior, acting in good faith, and the prohibition of abusive practices. Treating customers fairly means developing, marketing, and selling products in a way that puts clients' interests ahead of the interests of the agent, insurer, and intermediaries. Providing clients with accurate, clear, and sufficient product promotional material before, during, and after the points of sale that allows them to make informed decisions. Providing information to clients during the lifetime of their contracts which allows them to make informed decisions. Avoiding, or managing, any conflict of interest that would affect the fair treatment of customers. Minimizing the risk of sales that are not appropriate to the client's needs. Ensuring advice is relevant. Dealing with client claims, complaints, and disputes in a fair and timely manner. The fair treatment of customers should be the objective of every agent. Agent actions should support the principles listed above and in the full guidance, which is available online. The recommendation for purchase may be presented as a single recommendation, or as a comparison between a primary recommendation and secondary choices, or as several options. Every recommendation will have pros and cons. These must be disclosed in the reason why letter that an agent prepares and is a requirement for agents from both regulators and insurers. The agent must discuss the information in the letter with the client to help him understand the product recommendation and record it in his client notes. This ensures that the rationale behind the decision is available should the recommendation be questioned in the future. 5.1 Finding for a segregated fund. When the needs analysis is completed, as shown in Chapter 4, the agent may find a set of client characteristics that shows the best recommendation to bring forward as a segregated fund. 4. Instance, the client wants an investment with the benefits of an insurance contract and the ability to tap into the performance of the capital market. His needs indicate a long-term investment is most suitable. He is not seeking income from this investment, at this point in time or for the minimum duration of a contract. The agent properly concludes that a segregated fund investment should be recommended. There may be other factors that lead the agent to conclude the segregated fund recommendation is most appropriate, such as the guarantees offered or the ability to bypass probate. He must analyze benefits and limitations in view of his client's needs and make a thorough comparison of funds suitable for those needs. 5.1.1 Fund Analysis. As shown in Chapter 2, the agent has a wide selection of funds from which to choose to develop his recommendation. He must be methodical and accurately analyze what is available to arrive at an option or options, based on the client's investor profile. This involves staying up to date on new fund introductions and other similar developments through various industry channels. The agent should read industry journals and the marketing materials provided to him. He should also seek out the product wholesalers for their input. It is not adequate to rely on old standbys alone. The agent's analysis and subsequent recommendation should have nothing to do with the rate of commission or trailing fees offered by the fund. Client suitability is the only standard by which To judge whether a fund is a good match for client needs, analysis should be based on current information, and it should be provided to the client in a timely fashion. Each insurer has information readily available on their funds, and the agent may choose to supplement these details with other research. Third-party sources of information, such as that gleaned from the internet, must be considered very carefully. Sources must be verified as being accurate. The agent may wish to obtain approval from his compliance officer before presenting any of this type of information to the client. Information provided to the client can be fact-based and/or opinion-based. The agent should be clear with the client about which information is factual and which is his opinion. Every client is unique and presents an individual set of characteristics. An analysis coordinates these characteristics with fund details to arrive at a fund that is the best match. 5.1.2 Supporting the segregated fund recommendation. The agent must determine which factors of the product are of greatest importance to client needs, based on the investor profile. Chapter 4 provides a thorough breakdown of those considerations. The agent must be able to prioritize those needs, as well as the segregated fund features that fit those needs. For example, if the client is most concerned that he will lose capital invested, then the maturity guarantee should be at the top of the agent's features list for that client. The agent can show that full protection of capital is provided by some funds through a 100% guarantee. Moreover, if the segregated fund is being acquired for estate planning purposes, then by passive probate may be of greatest importance to the client in those provinces where probate applies. After prioritizing needs against features, the agent reiterates to the investor the characteristics of the fund that align with his objectives. The agent focuses on the primary benefits that make the recommendation a suitable choice and points out limitations. Other factors of lesser importance can rightly take a back seat in the recommendation. However, the client needs to see the whole picture in order to understand the choice or choices that are presented. 5.1.3 Making the recommendation. When a suitable recommendation is ready to discuss with the client, a meeting is required in which the agent can substantiate his findings and the client can ask questions and provide direction. Prior to the COVID-19 pandemic, such a meeting would typically be held in person. The agent brings his written documentation for discussion and a client sign-off would be completed with the agent present if an application is completed. During the pandemic, the in-person approach has been largely replaced with the online virtual meeting, phone meetings, and electronic signatures. A virtual meeting, such as Zoom, needs planning and organization to be successful. It starts with both parties being able to manage the technology to log in, enter a password, access supporting documents, provide an electronic signature, when necessary, and log out. The internet connection must be good enough to support the meeting without pauses and disconnecting. Some people do not have the necessary computer skills and the agent will be required to send documents by courier and complete the discussion with the client over the phone. This can put the agent at a disadvantage because he is unable to read the visual cues the client might show, like nodding in agreement or shaking his head in disagreement. An agent may find that a hybrid approach is best, sending physical documents and meeting virtually to discuss what was sent. Clients who are willing to receive documents online should be provided with them prior to the virtual meeting to ensure the documents are received, and better yet, reviewed before the meeting. There is considerable etiquette to be followed for a virtual meeting. Agents should research the rules before they embark on meeting virtually. When the client needs to issue payment, this is now best accomplished by an electronic transfer from the investor's account to the account you specify to receive the funds. Problems can arise when the amount of payment exceeds his daily transfer limit, or he may lack the wherewithal or confidence to make the payment electronically. In such a case, a check is issued for which you should send a courier for pickup. You do not want to force the investor into going to a post office. and transacting with employees and other customers to mail or courier the check. The need to meet virtually eliminates the physical signature on documents. Electronic signatures. E-signatures are now the order of the day. An electronic signature can be provided in a number of ways, including a physically signed document that is then scanned and transmitted, a scanned signature pasted into an electronic document, a typed name, a signature created using a stylus or finger on a touch screen, clicking an electronic confirmation. Some people are reluctant to use such electronic formats, fearing that their signature could be copied and used elsewhere or that the document could be modified after signing. Secure electronic signature technology uses algorithms and encryption to determine the authenticity of the signature and the signed document. It is available from different providers. When relying on e-signatures, the agent will not be aware of undue influence or duress being applied to the client, whether the client is a victim of fraud or identity theft, or if the client has mental capacity issues. The client could feel that he did not have the opportunity to ask questions or request more information about the document he is signing. The agent must be alert to any red flags that might indicate a lack of consent and must never proceed unless fully satisfied that the client understands his obligations. Even though the relationship may be digital, it will be more important than ever to ensure the agent keeps hard copies of meeting notes and relevant documents in his client file if decisions made or actions taken are challenged in the future. 5.2 Segregated Fund Recommendation. Based on his analysis, the agent brings forward his recommendation and is able to back up his conclusion to the client. The recommendation made to the client must focus on fund specifics. The agent seeks consensus with his client that the recommendation is sound based on information gathered and needs expressed. The client makes the final decision. The next step is to proceed with the application. If the client's decision is contrary to recommendations, the agent should document the client's reasoning and seek input from his manager about proceeding. If a client returns to the agent in the future for a subsequent investment, an assessment of needs and objectives must start afresh. An agent must never assume that previously identified needs can underlie another recommendation. Each investment must be analyzed separately to determine the best available product is brought forth. Every segregated fund recommendation should include the following elements, which are addressed in the next sections. Identification of fund and its characteristics. Deposit and funding. Value of guarantees. Contract maturity date. Principal risks of recommendation. Reset. Contract riders. Fund taxation. Fund sales charge. Fund management expense ratio, MER. Fund details. Fund penalties. 5.2.1 Identification of fund and its characteristics. The recommendation will identify the insurer that provides the fund, e.g. XYZ Life, and how the fund is invested, e.g. equity, income, bond, or other. The agent ensures that the investor understands that he is investing in a pooled investment concentrated as per its type, i.e. stocks, bonds or other, and how returns in the fund are achieved, i.e. capital gains, dividends, and/or interest. Like must be compared to like in the recommendation when comparing performance, management, and fees, i.e. a balanced income fund to another balanced income fund. If two different types, i.e. a balanced income fund and a balanced growth fund, are recommended, the rationale must be provided for each type. 5.2.2 Deposit and funding. The investor must reveal how much he intends to deposit to the contract or how he proposes to fund the contract. A minimum is specified for each fund for both lump sum deposits, which include transfers, and periodic deposits. Some insurers also have a maximum amount permitted for the premium. The agent follows the client's lead in regard to the sum being invested and should not push for more than what has been deemed appropriate through the needs analysis. The first-time client may need to develop a comfort level with the agent and the product before making a larger financial commitment. The premium is allocated to fund units at their net asset value, NAV, on the valuation day that applies to the lump sum or periodic deposit. The number of units received may not be the same across all recommendations since the number depends on the NAV per unit of each fund. Receiving more or less units of one fund over another is not an indicator of fund quality or performance. The NAV per unit of a fund forms a benchmark against which future performance is monitored. It is essential that products with similar characteristics be compared in the recommendation. When different elements enter into the comparison, they must be stressed as a differentiator. The following example shows how the same amount of deposit results in the investor receiving a different number of units. There are other potential differentiators between the funds to form a further basis for comparison, and they will be addressed later on in the chapter. 5.2.2.1 Lump Sum Deposit. A lump sum deposit is a one-time deposit that may or may not be accompanied by subsequent periodic deposits. If there are no subsequent periodic deposits, the maturity guarantee of the contract is based only on the single sum deposited. Thus, if the investor has a 10-year time horizon for an investment, it is appropriate to recommend a lump sum deposit to take full advantage of the guarantee if funds are readily available. The investor needs to satisfy the minimum deposit stated for the fund. The sum for deposit is received via a personal check from the client or a transfer from another financial institution or pension plan. 5.2.2.2 Transfers. A transfer of money is initiated by the firm that will be receiving the money when funds are being transferred from one institution to another. Relevant details are needed from the client, including the name of the organization or company from which the money will be transferred, an account number and contact details. An investment statement provided by the client can be very helpful for obtaining accurate information. If a registered account is the source of transferred money, then the contract is set up as another registered account to continue its tax deferral. The same is true for locked-in accounts. A transfer from a locked-in account must go to another locked-in account. Non-registered funds can be transferred into a registered retirement savings plan, RRSP, account, or a tax-free savings account, TFSA, and will be a contribution for the year. Sufficient contribution room has to be available for the amount being transferred. If contribution room is exceeded, tax penalties will apply. 5.2.2.3 Periodic deposits. Deposits made on an ongoing basis must meet the minimum requirements set by the fund manager. The cash flow statement for the client, described in the previous chapter, indicates whether the sum he proposes to invest is appropriate and manageable. As with lump sums, periodic deposits can be made to both a non-registered contract and an RRSP contract and TFSA contract. Deposits received throughout a year are RRSP/TFSA contributions, for which the investor has to have available contribution room. As seen previously, periodic deposits may create a series of maturity dates and maturity guarantees. One guarantee for each deposit or group of deposits. A client may invest to align his needs with the maturity dates of his deposits. This would be true if an investor wanted to receive maturity proceeds for each year he is retired between ages 60 and 65, at which time his pension would begin. However, if long-term investment growth is the reason for the investment, the multiple maturity dates of the deposit-based contract may not be significant to the investor. Example: Chris has a segregated fund contract set up on the basis of periodic deposits that provides a 75%/75% maturity and death benefit guarantee. At the end of each month for a year, he deposits $250 to the contract. Therefore, each of the 12 deposits is guaranteed at $187.50, $250 times 75%, on each of its 12 maturity dates. Chris's time horizon should correspond to the series of maturity dates. Since the net asset value per unit rises and falls, each deposit may acquire a different number of units. 5.2.3 Value of guarantees. The agent may wish to recommend a set of guarantees for each of the maturity guarantee and death benefit guarantee based on what he has learned about the client, including the client's tolerance for risk. Some clients may agree to invest in relatively higher risk equity funds because they know that the principal sum invested is protected by the two guarantees. Once the choice is made, an actual dollar value of guarantees can be ascertained on the basis of the financial commitment the investor makes or will be making. The agent may also wish to point out that guarantees apply at the rate offered by the recommended fund, either 75% or 100%. If a switch is made from one fund to another during the contract, the guarantee may change if the new fund has a different rate for its guarantees. 5.2.3.1 Maturity Guarantee. The maturity guarantee is automatically provided in all segregated fund contracts as 75% or 100% of deposits at maturity. It should be reiterated to the investor that deposits are guaranteed to the percentage selected for maturity. It is good practice to state the percentage in the dollar value of the guarantee. If the market value of the account is greater than the guarantee due to fund performance, the investor receives the market value. The investor loses the benefit of the maturity guarantee if he surrenders the contract before its maturity date. He also will find that the guarantee is adjusted if a withdrawal is made. The percentage of guarantee, i.e., 75%, remains the same after a withdrawal, but it is based on the new, lower balance. Again, the dollar value of the adjusted sum should be stated. The agent who recommends a fund with one guarantee or the other has to be able to substantiate the decision and compare the effect of a lower or higher MER, in addition to other fund attributes, to make a thorough analysis for the client's benefit. The agent calculates the value of the guarantee and informs the investor of the sum that could be obtained as a result of the guarantee to reinforce this benefit of the segregated fund contract. The agent will also want to stress to the investor that, while the maturity guarantee protects the investor against poor performance, the upside for growth is unlimited. Some funds have higher potential for growth than others. This is related to their risk, and an assessment of risk is detailed in the information folder and fund facts for each fund. 5.2.3.2 Death Benefit Guarantee. Just like the maturity guarantee, the death benefit guarantee is an automatic part of the contract and is a feature of all segregated funds. The agent may feel strongly about which guarantee, 75% or 100%, the investor should have, and this forms part of his recommendation. It helps the investor to know the dollar amount that would be received. This guarantee can have great value in the peace of mind it brings to those whose health is impaired at the time the contract is taken out, or to those who are older. 5.2.4 Contract Maturity Date. The minimum maturity date is 10 years from the deposit date, and this date should be stated to the client in actual time, i.e., the month, day, and year for maturity based on an initial deposit such as May 16, 2032, e.g. if the deposit was made on May 16, 2022. The client should also be shown the relationship between a higher guarantee or guarantees and an extended maturity date. Some segregated funds that offer 100% guarantees require a 15-year period to maturity. Again, use an actual date to make the time less abstract, so May 16, 2032 would become May 16, 2037. Although the minimum term to maturity is 10 years, many insurers specify a minimum 15-year term. This detail will be set out in the contract. Be aware of it and ensure the client knows. This is part of an agent's disclosure requirements. 5.2.5 Principal risks of segregated funds. The risks of segregated fund investing are expressed in a warning that appears on the cover or face page of a contract that states in bold type: any amount that is allocated to a segregated fund is invested at the risk of the contract holder and may increase or decrease in value. 30. Thus, the investor is alerted to a possible danger. How does the risk arise? Fundamentally, the risk of a segregated fund results from how the fund invests the deposits it receives from investors. As we have seen, each fund is highly diversified within its category. Each investment within each fund has its own individual risk. The risk of individual investments is averaged out, that is, diversified, to produce the overall risk for the fund itself. Fund risk is plotted on a scale with 6 classifications: very low, low, low to moderate, moderate, moderate to high, and high. Even those funds at the bottom of the risk scale will go up and down in value because of changes in interest rates, economic conditions, and business markets linked with that category of funds. Funds are also subject to specific risks, based on their type. For instance, a bond fund is highly susceptible to interest rate risk but has little market risk. An equity fund, on the other hand, has higher market risk and equity risk and low interest rate risk. In developing a recommendation, the agent should take into consideration the risk assessment of each recommended fund, the forms of risk associated with the recommended products, e.g., exposure to equity risk and inflation risk, the risk tolerance of the investor. 5.2.6 Reset. The reset feature allows the investor in a segregated fund to lock in, at specified intervals, example, once a year, increases in the market value of the investment. If market value has declined at a reset date, then the reset feature is not utilized. Not all segregated funds offer reset. A recommendation that includes a fund that provides reset and one that does not must show the cost of reset. That cost may be apparent through a higher management expense ratio, MER. There may be other aspects of reset that need to be compared between recommendations, such as number of resets permitted in a year or whether reset is automatic or on client instruction. The recommendation needs to show the client how reset extends the maturity date, and increases the maturity guarantee and death benefit guarantee of the contract. Concrete examples should be provided of the effect of a hypothetical reset on the actual deposit amount and date. Example: Nasser's agent, Farah, recommends a segregated fund contract that will have a 10-year maturity date from April 23, 2020. Nasser has a $5,000 premium available and wants a 75%/75% guarantee structure. The average rate of return on the recommended fund is 5.02% annually over the past 10 years. The maturity date of his contract will be April 23, 2030, 1 month after his 65th birthday. The cash paid out then will help him delay both his Canada Pension Plan, CPP, or Quebec Pension Plan, QPP, and Old Age Security, OAS, benefits, in order to receive the deferral bonus on both. The contract would have an automatic reset every 2 years on its anniversary date. The first reset would be April 23, 2022. This locks in growth. However, the maturity date of the contract would advance to April 23, 2032. Based on this addition of 2 years to the initial maturity date, Nasser will have to begin his government retirement benefits sooner. This means they will be paid at a lower rate. Considering that resets will be automatic, Nasser and Farah should estimate before he enters into the contract whether he is better to take the resets and extend the contract or consider another fund with a 10-year term to maturity, for which resets are voluntary rather than automatic. 5.2.7 Contract Riders. The recommendation must address whether an income rider should be added to the contract. If an income rider is added in the form of a guaranteed minimum withdrawal benefit, GMWB, or guaranteed lifetime withdrawal benefit, GLWB, the characteristics of the rider have to be thoroughly described. These riders are not widely available, so comparisons between providers or products may be difficult to make. This should also be pointed out to the investor. 5.2.8 Fund Taxation. Taxation of the fund will depend on whether the contract is set up as a registered or non-registered account. Taxation rules are predetermined by income tax legislation, so no point of recommendation can usually be made on this basis. As a reminder, deposits to a registered contract will generate a contribution if the contract is an RRSP or TFSA. RRSP contributions are tax-deductible. Taxable allocations of the returns generated by the fund will be declared and will increase the adjusted cost base, ACB, when the account is not registered. Withdrawals are taxed very differently depending on whether the account is registered or not. The agent may point out the primary form of return earned by the recommended investment, e.g., interest, and compare tax advantages of receiving allocations of capital gains or dividends over interest when the account is not registered. Allocations and taxation were reviewed at length in Chapter 2. 5.2.9 Fund Sales Charge. A sales charge or load is paid by the investor. As discussed previously, FEL and DSC sales charges for segregated funds may be eliminated because they do not align with the fair treatment of customers. DSC redemption schedules for mutual fund sales made prior to the ban will be allowed to run their course in Ontario. This means DSC charges could apply up until 2028 or 2029. May 2, 10 Fund Management Expense Ratio, MER. The management fee covers management and operating expenses and taxes. Trailing commissions are paid from the management fee. The amount charged as a trailing commission is clearly disclosed in the fund facts for each fund that all potential investors receive. The management expense ratio, MER, of a fund is the percentage of expenses relative to the average value of its assets. MER is not based on performance and it is charged regardless of performance. MERs vary between funds and have a financial impact because they reduce the return on investment. The higher the MER, the greater the reduction in return to the investor. Fund performance is reported net of MER and returns received net of MER. In other words, if a fund has a reported return of 4.2% and a MER of 2.8%, the real return on the fund is 7%. 4.2% plus 2.8%. However, the investor earns 4.2%. Example. Roberta has invested $10,000 in Fund A with an MER of 3.5% and $10,000 in Fund B with an MER of 1.5%. Both funds have a reported 5% rate of return. Fund A, the real rate of return, before MER, is 8.5%, 5% plus 3.5%. The fund manager earns 8.5%, keeps 3.5%, and pays Roberta 5%. Fund B, the real rate of return, before MER, is 6.5%, 5% plus 1.5%. The fund manager earns 6.5%, keeps 1.5%, and pays Roberta 5%. However, if a fund with a higher MER performs much better than a fund with a lower MER, the investor may quite happily pay the higher MER since his investment is growing at a better rate. Example, Kant. If instead of a 5% return, Fund A has a reported return of 6.2%, the real rate of return is 9.7%, 6.2% plus 3.5%. The fund manager earns 9.7%, keeps 3.5% and pays Roberta 6.2%. May 2, 11 Fund Details. It is an agent's responsibility to discuss and explain the contents of the information folder including Fund Facts to the investor. 31. The information folder and fund facts provide important details about each fund. Fund facts are particularly useful because they are individual outlines of each fund. Their information is provided In such a way to facilitate comparison between funds, they are brief summaries of the many details each fund entails and written to be easily understood. 5.2.11.1 Delivery of Fund Facts. Fund facts are part of the information folder and are delivered to a prospective investor before the application for the contract is signed. They can be delivered in person or electronically via email or through an online site. The client must acknowledge that he has received the information folder in writing or in conversation with the agent. 32. Providing fund facts is mandatory as part of the disclosure process that accompanies a sale. 5.2.11.2 Delivery of financial statements. The financial statements show selected key financial information about a fund and are intended to help the client understand the fund's financial performance for up to 5 years, depending on the fund's inception date. They are not provided with the information folder. Clients may submit their request for financial statements to the agent or directly to the insurer providing the fund. All funds release annual audited financial statements and semi-annual unaudited financial statements. Clients with a more sophisticated understanding of investing may appreciate the additional level of detail provided in the financial statements. 5.2.11.3 Total value of fund. This dollar figure, shown in the fund facts for the fund, reveals how much is invested in the fund. It is relevant because it is the figure on which the MER is based. Funds with a higher total value can potentially offer a lower MER. This benefits the investor since the MER erodes returns. 5.2.11.4 Fund units, net asset value per unit and market value. The number of units outstanding and the net asset value per unit are shown in fund facts as it. The date specified. Market value of units will be the current value, or value as of the most recent valuation date. Over its lifetime, a segregated fund may be divided, in which case unit values will decrease, or funds may consolidate, in which case unit values will increase. Neither event changes the market value of the fund. This data is used for comparison in the recommendation and is not an indication of the quality of the investment. 5.2.11.5 Date of inception. This is the date on which the fund began operations. Funds with long track records offer more history by which investors can assess overall fund performance. Funds with longer histories have experienced various market conditions and have more reliable performance data. Therefore, a client with a lower risk tolerance will appreciate a recommendation that includes a fund with a longer record since he may see historical lows and highs in addition to typical results. 5.2.11.6 Performance data. Performance data is always historical, what has happened over a specified period of time. It may be useful to compare funds, but must never be used to predict what will happen in the future. Moreover, many requirements must be satisfied for performance data to be included in advertisements for funds, and it is essential that an agent not revise this data in any way. Performance is stated as an average return and year-by-year return. Black small square. The average return states how much a $1,000 investment with the most basic guarantee, 75%. Maturity/75% death benefit, would be worth, and its annual average return is a percentage for the years shown. Black small square. Year-by-year returns show the fund's annual performance in a chart format. It also states the number of years of positive performance and negative performance. For example, the fund was up in value for 6 years and down in value for 4 years. Where a segregated fund invests in real estate, the purchase and sale of real estate in the fund is described for the previous 5 years. Funds with a history of less than 1 year do not report performance data. 5.2.11.7 Fund manager. Some performance credit, or blame, can be assigned to the manager of the fund. The fund manager appears on the fund facts, although the document does not show how long the same manager has been in place. If a fund shows a track record of good long-term performance but the manager has only been with the fund for the last year, it may be wise to question whether the results will hold up. Likewise, if results align with management tenure, good results over the 5 years with the same manager, it may be fair to conclude that the manager has some impact on results. Finally, if one manager seems to have a record of performance across funds, that data may be important in the decision-making process because that manager may be partially responsible for fund results. Fund managers are regularly reviewed and can be changed if they do not meet expectations of the insurer. 5.2.11.8 Portfolio Turnover Rate. The portfolio turnover rate is expressed as a percentage of the fund's holdings that have been replaced during the previous year. The turnover rate is related to the MER because high turnover translates into higher expenses due to buying and selling costs. A low turnover indicates a buy and hold investment philosophy, and correspondingly lower costs for trading. A lower MER can improve investor returns. May 2, 12 Fund penalties. The recommendation for a segregated fund investment should be accompanied with a reminder of the long-term nature of the investment, regardless of which fund or funds are selected. Fund penalties should be pointed out in reference made to how they will be calculated, but should not be a basis for comparison since the agent does not want to imply approval to withdraw from the fund or surrender the investment prematurely. Both activities should be discouraged. Some charges or penalties include account closing charge, frequent switching charge, fees to set up registered accounts, short-term trading fee, unscheduled withdrawal or switch fee. 5.3 Finding for an annuity. An investor seeking income, in a relatively straightforward product, is a likely candidate for a payout annuity. Those looking for a very conservative non-income paying investment without the limitations of segregated funds, such as the 10-year term to maturity, sales charges, and annual MER, will be potential candidates for an accumulation annuity. As is the case for segregated funds, the agent must satisfy the principle of suitability for annuities. He must analyze benefits and limitations of an annuity investment in view of his client's needs and make a thorough comparison of annuities suitable for those needs. The agent's analysis leads to a recommendation that he backs up to the client in the reason why letter. Documentation of the recommendation is key in order to show alternatives presented, if ever questioned in the future. The client agrees that the recommendation is sound based on information gathered and the needs he expressed and makes the final decision. This, too, should be recorded in agent notes. The final step is to proceed with the application. 5.3.1 Annuity Analysis. In Chapter 3, the following questions were posed in assessing an annuity to understand its features, benefits, and limitations. Is the annuity being created to pay income or for savings? How many lives will be covered? Will the annuity payments be made for a period of time or life? When will income begin? Will income be a level payment or variable? How will the contract be funded? Which form of taxation will apply? Now, for the annuity recommendation, these questions become: does the client need income or savings? Is it sufficient for the client to be covered or should it be the client and his spouse? Is the income need temporary or lifelong? When does the client need income to begin? Does the client need level income that he can count on or is variable income better? How will the client fund the contract? What will be the tax impact on the client? The agent has many products to analyze to look for appropriate answers to these questions and formulate a suitable recommendation. It may not be possible to arrive at a recommendation that ticks all boxes on the client's list of needs and circumstances. In this situation, the agent can proceed with the best available recommendation while pointing out its advantages and shortfalls. An agent's ethics may be tested. If the most suitable recommendation means the loss of the sale because the agent cannot provide the best annuity for the client or the annuity product itself is not the best choice. Regardless, the only course of action available to the agent is to be honest and explain to the client the rationale Further recommendation. 5.3.1.1 Current offerings. The agent needs to keep himself apprised of new product introductions and innovations. It is never appropriate to rely on former decisions or only on knowledge of a stable of long-standing products. Every decision should be based on a review of what is currently available, which may include the new and old. 5.3.2 Supporting the annuity recommendation. Once the agent has determined which investment factors are most important to client needs, based on the investor profile, he may find that the characteristics of annuities make them the preferred choice, rather than segregated funds. For instance, if income is a prioritized need, then an annuity may be the best recommendation. It may also be suitable to acquire both a segregated fund to protect some of the investor's capital while enabling growth and an annuity for its income stream. Most importantly, the agent must have a sound basis for his annuity recommendation that is a result of client needs weighed against product features. Limitations need to be reviewed. All factors relevant to the decision should be presented so the client understands the reasons the annuity is the best investment considering his objectives. 5.4 Annuity recommendation. A logical starting point for the recommendation is the type of annuity best suited to the client. Once the purpose of the annuity has been determined, the agent and client must determine how the deposit will be made, when payments will begin, the payment schedule, whether payments will be level or variable, and the guarantee period best suited to manage the risk of the investment. Every annuity recommendation should include the following elements, which are addressed in the next sections. Type of annuity and its characteristics. Timing of payments. Annuity rate. Value of guarantees. Principal risks of annuity recommendation. Annuity penalties. 5.4.1 Type of annuity and its characteristics. There are two fundamental types of annuities, payout or accumulation. A payout annuity is recommended when income is indicated. The agent must also recommend how long the income should be paid, either a term or life. Term requires a choice of time periods, i.e., 10 years, 20 years, or to a specified age, such as age 90. Life requires a recommendation of lifelong income for the client alone, leading to a personal contract, or the client and his spouse, leading to a joint and last survivor contract. A prescribed annuity, in which the same amount of interest and capital is received by the annuitant in every payment, is generally considered preferable to an annuity taxed by the accrual method. Structuring the annuity so that it will benefit from being prescribed can also be incorporated into the recommendation. The agent has to be aware of requirements for payout annuities funded by a transfer from a registered or locked-in account, such as age limits and minimum withdrawals. These requirements take precedence over client needs and wants and must be fulfilled. An accumulation annuity is recommended when the analysis indicates the suitability of an investment return approach. The agent also recommends a suitable maturity date for the annuity, based on the time horizon of the investor. 5.4.1.1 Minimum and maximum investment. A minimum investment for each type of annuity is stated by the insurer offering the product. A recommendation cannot be based on less than this amount. A maximum may also be specified by the insurer. The client must have funds available in cash or by transfer. 5.4.1.2 Maturity date. A maturity date applies to both a term annuity and an accumulation annuity. Determining the length of time until the maturity date depends on the income need to be satisfied by the term annuity, and the time horizon for the accumulation annuity. If the accumulation annuity is not being used to save for a specific event and therefore does not have a time horizon, the agent determines the reason for acquiring the annuity and matches a maturity date accordingly. If there is a need for higher income, a shorter term to maturity for the term annuity should be recommended since payments will be higher when they are made over a shorter period of time. If the need is to create a stopgap source of income, also called income bridging, for those who have stopped working and are not yet entitled to full retirement benefits, then the length of the term annuity should be aligned with the period of time between when the individual stops work and starts receiving his pension. Example: Jane has been employed as a senior executive at a manufacturing firm for 19 years. At age 60, she is given a package from her employer that consists of a lump sum equal to 5 years' salary providing she leaves the company immediately. She has a pension with her employer in which retirement benefits are available at age 65. Jane accepts the package and uses the lump sum to purchase a 5-year immediate term annuity. About the time her annuity payments end, her retirement pension begins, so her income remains constant from the time employment ends and retirement begins. 5.4.2 Timing of payments. Payments from a payout annuity may be recommended to begin immediately or at a later date, known as a deferred annuity, based on the client's need for income. 5.4.2.1 Immediate payments. An immediate annuity, in which payments begin on the next scheduled payment date, could be recommended to an investor who has funds available and an immediate need for an income stream. If a registered retirement savings plan, RRSP, at maturity is being converted to an annuity payments must begin in the year following. They cannot be deferred to a later date. 5.4.2.2 Deferred payments. Deferred payments are suitable to recommend to an investor who wants to accumulate deposits in the contract prior to starting income or who wishes income to begin at a future date. The future date may be an obvious one, i.e., when retirement begins, or another time is determined in the investor profile. 5.4.3 Annuity rate. The annuity rate depends on how much money is invested, the interest rate, and the length of the contract. The rate offered by the insurer for the recommended annuity will be in force for the duration of the annuity once the contract is finalized for an immediate annuity or when payments begin for a deferred annuity. Annuity rates vary between insurers, and agents who have the ability to shop around for best rates can incorporate those rates in their recommendation. There are many annuity calculators available on the internet for the do-it-yourself investor that can show some very advantageous annuity rates. The agent's recommendation is a combination of benefits for the investor that includes the offered annuity rate, but is not based on the annuity rate alone. Annuity rates used by insurers are different for fixed income annuities and variable income annuities. 5.4.3.1 Fixed income annuity. A fixed income annuity in which each payment is equal is best suited to an investor without the risk tolerance needed for a variable income. An investor who wants or needs income security is well served by a fixed rate of payment. 5.4.3.2 Variable income annuity. An investor who has risk tolerance for the ups and downs of the stock and bond markets may prefer a variable income annuity over one that provides a fixed income. His payments rise with a rising market or fall with a declining market. A recommendation for a variable income annuity should take the age of the investor into account, since losses incurred at an older age are more difficult to make up than when a person is younger. An indexed annuity sees payments increase based on the schedule provided in the contract, in step with increases in the cost of living. There is a significant price premium for adding the indexing feature when purchasing an annuity over a longer term, and a recommendation would properly show the cost for an annuity that is not indexed in addition to the indexed annuity. 5.4.4 Value of guarantees. Guarantees customize an annuity contract to suit the needs of the policy owner. They increase the cost of the annuity for the policy owner and consequently decrease the amount the annuitant receives. On the other hand, they provide the policy holder with the assurance that a minimum amount will be paid to the beneficiary in the event the annuitant dies before the end of the guaranteed payment period. 5.4.4.1 Life annuity guarantees. The guarantee period of a life annuity minimizes investment risk for the investor. He can be assured that, in the event the annuitant dies during the guarantee period, a sum representing the balance of the guarantee will be paid to a beneficiary. Therefore, the guarantee ensures a minimum return from the investment during the guarantee period. Death of the annuitant after the end of the guarantee period does not generate a payment to the beneficiary. The recommendation can address risk tolerance by proposing a longer guarantee period for a client with low risk tolerance. The longer guarantee period produces a lower income payment to the annuitant. This must be balanced against the likelihood of the beneficiary receiving a payment when the annuitant dies. A higher risk tolerance may indicate a shorter guarantee period. The shorter guarantee period rewards the annuitant by making higher payments but puts the beneficiary at risk since he may receive nothing if death of the annuitant occurs after the guarantee period ends. Usually the need of the annuitant for income is considered before the beneficiary's eventual need for proceeds from the contract. Age also enters the equation for the length of the guarantee period, recommending a 20-year guarantee period for a life annuity acquired at age 80 may be overly expensive and optimistic. 5.4.4.2 Return of Premium Guarantee. A return of premium guarantee, added as a rider to the contract, also is a risk management technique. It pays the beneficiary the full deposit to the contract if the annuitant dies before the first payment. Recommending the rider is appropriate for those who have a low risk tolerance. When a deferred annuity is recommended, when the annuitant is in poor health, or to ensure return of principal invested to the estate. 5.4.5 Principal risks of annuity recommendation. The principal risk of an annuity recommendation is an annuity rate that improves in the future, due to an increase in interest rates. The higher rate will be unavailable to annuitants whose contracts are already set and, therefore, they will earn less than they would have received if they had had the higher rate. This risk may be managed by recommending that a series of annuity contracts be acquired over a period of several years. This approach is called laddering. Each annuity has its own annuity rate, but there is no guarantee that interest rates will rise. When interest rates rise, they tend to do so very gradually. To risk laddering and the hope of rising rates, annuity purchases would have to be stretched over a number of years. Inflation risk is a significant risk to annuity investors. It is related to the issue of the set annuity rate and also the fixed payment rate. Inflation risk can be managed by an indexed annuity. The investor must decide whether its additional cost is worthwhile. Finally, an annuity allows little or no flexibility for the investor. He loses control of his capital in exchange for the security of the income stream. This may be suitable for some investors, yet not others. 5.4.6 Annuity penalties. An annuity is a commitment, for a period of time or life. Although some annuities may permit a withdrawal or surrender, others do not. Payout annuities cannot be surrendered. However, accumulation annuities are generally redeemable, although penalties may apply. A term certain annuity may be surrendered upon approval of the insurer. The ability to withdraw funds from the contract or surrender it prematurely should not be a basis for comparison or form part of the recommendation to buy. The recommendation must emphasize the commitment made by the investor and the guarantee made by the insurer to the investor. Chapter 6. Segregated Fund Contract. Competency Components. Analyze the available products that meet the client's needs. Implement a recommendation adapted to the client's needs and situation. Provide customer service during the validity period of the coverage. Competency subcomponents. Analyze the advantages of segregated funds in comparison to other types of investment in regards to the client's needs. Confirm the requirements that must be met to implement the recommendation. Validate the appropriateness of contract amendment, renewal, and termination application in regards to the client's situation. Inform the claimant of the claims process. 6. Segregated Fund Contract. Only a licensed life agent can work with the investor to prepare and submit the application for a segregated fund. The application is one step along the path to ownership of the investment. It is preceded by the recommendation of the agent in the reason why letter and followed by the financial contribution to the contract. The finalized contract is evidence of the agreement between insurer and investor and obligates both parties to the terms of the investment. 6.1 Contracts. Contracts are legal documents that bind their parties to specified terms and conditions. Many forms of contract exist. The contract between an insurer and an investor for a segregated fund is an individual variable insurance contract, IVIC. 6.1.1 Individual Variable Insurance Contract, IVIC. The IVIC spells out the conditions for buying, terminating, withdrawing and receiving the benefits from the segregated fund investment. It is a document of disclosure intended to both reveal what the investor is buying and reinforce the risk associated with the investment. The insurer makes these contractual commitments to the investor. Guarantees and benefits. Method to determine the value of benefits related to the market value of the fund and their surrender value. Percentage of premium allocated to provide the benefits related to the market value of the fund. When the value of the fund and benefits are determined. Fees and charges, or how fees and charges are calculated. Right to make changes to the contract. The contract states what information forms part of the contract. It includes identification of the IVIC and the segregated fund. Management expense ratio, MAR. Risk disclosure. Fees and expenses. Right to cancel. Statement of the accuracy of the fund facts information and the remedy for any error in the information provided by that document. Finally, the contract states. The contract may be rescinded in writing to the insurance company, at the address it has specified. Within 2 business days after the contract owner receives confirmation of the purchase. If the contract is rescinded, the contract owner receives the lesser of the amount invested or the value of the fund on the valuation day following the day the insurer received the request for rescission. Fees or charges are also refunded. The contract owner is deemed to receive a confirmation 5 business days after it has been mailed by the insurer. All segregated fund contracts are required to provide this information. Thus, the investor is equally protected in his contractual rights regarding these details regardless of which insurer he chooses to invest with. A contract may be attached to the application form or may be provided to the investor after the insurer receives the application. Delivery of a sample contract does not constitute purchase of the segregated fund. Purchase is confirmed by the effective date of the contract. The effective date is the valuation date following the receipt of the first deposit and when all contract criteria have been satisfied. The contract is assigned a unique reference number. This number is used whenever instructions or information about the contract is conveyed between contract owner and insurer. 6.2 Investor requirements. The investor must provide the information needed for the contract to be prepared by assisting the agent in filling out the application. He must be accurate and truthful. He should also aim to make the decisions that will create the contract most suitable to his needs and objectives. Those decisions may be based on the life insurance agent's recommendations, or the investor may arrive at them independently. The agent proceeds on the basis that the investor understands the decision he is making and can appreciate its consequences. If the agent is unsure of the client's ability to understand a part or all of the contract, the agent should seek advice from his direct supervisor before proceeding. The second requirement that must be met by the investor is to fund the account. 6.2.1 Application Form. The application form is completed by the investor and the agent together. This may be together virtually. The investor, who is the applicant, provides the necessary information, the agent records The information on the form itself in its electronic or paper format. Many details are collected. An application form is multiple pages in length. It requires enough time to complete so that information is recorded correctly and nothing is overlooked. The agent may need to explain certain aspects of the form so the investor fully understands his options and his commitment. A circumstance could arise that prevents the investor from fully comprehending the application. Certain aspects of the application or the agent's explanations. For instance, if the investor does not speak a language the agent understands, then the application should not be completed until steps are taken so that understanding exists. The agent may need to provide more information to the investor or provide a translator. The investor must review all information on the form and correct any inaccuracies. Then, the investor and annuitant, if they are not the same person, both sign and date the application electronically if need be. Their signatures confirm their agreement with the information. The agent must also provide specific information for the application to be processed. An exception is made to the requirement for the contract owner to sign the application when the contract owner is represented by a power of attorney, POA, for property. An agent may find a POA appointed for a client who is ill, mentally incapable, or absent from the country for a prolonged period of time. The individual with the POA can complete and sign the application on behalf of the contract owner. However, he may not have rights to name the beneficiary. A legal opinion should be sought in this circumstance. Information must be recorded by the agent carefully since it will become the basis for the contract. The agent must also ensure that all information needed is gathered since an incomplete application will be rejected by the insurer. At the time the application is made, the reason why letter is prepared. The reason why letter is one of the pillars of insurance's sales suitability. The letter is prepared by the agent and provided to the client. It proves that the agent has addressed a relevant insurance need or needs by making recommendations to a client, together with the basis for the recommendations, and whether or not the client has accepted or refused those recommendations. The reason why letter confirms facts, verifies the instructions received from the client, identifies the client's needs that the product meets and the needs that will be left uninsured, documents that the sale is suitable and the reasons why it is suitable, substantiates the client's understanding of his purchase. The reason why letter is not optional. The agent reviews it with the client, and both must keep a copy. 6.2.1.1 Registered or non-registered form. The segregated fund account can be non-registered or registered. Registered accounts are further categorized as locked-in or non-locked-in. There may be age restrictions when certain types of locked-in accounts can be established. However, there are no age restrictions for opening a non-registered account. The account in which the IVIC investment is made must be accurately selected. For example, an investor who believes he will be enjoying the tax deferral of a registered account may be financially disadvantaged if the account is set up in a non-registered form. To open a registered account, the contract owner needs to provide his social insurance number, SIN, for tax purposes. A registered contract requires the owner to be the same person as the annuitant. Ownership of the contract cannot be transferred and the contract cannot be used as collateral. A non-registered account, that is, an account not registered for tax purposes, may specify an annuitant who is not the contract owner. The owner may be an individual, a group of individuals or a corporation. The contract may be purchased until the date on which the annuitant turns 90. A non-registered account has the following benefits. Ownership can be transferred according to the rules of the insurer that has issued the contract. It can be used as collateral for securing a loan by assigning the contract to the lender. 6.2.1.2 Naming annuitant and beneficiary. The owner of the contract enjoys the rights of ownership, such as the ability to select and switch funds. He names the annuitant and beneficiary to the contract. As explained in previous chapters, the annuitant is the person on whose life the guarantees are based and whose death triggers payment of the death benefit. Once named, the annuitant may not be changed. However, in a non-registered contract, prior to the death of the initial annuitant, a contingent annuitant may be named to replace him if he dies. The contract continues until the death of the last surviving annuitant, and the death benefit is only paid out at this time. The beneficiary receives the benefit of the contract after the death of the last surviving annuitant. More than one beneficiary can be named. If this occurs, a percentage of death benefit must be allotted to each beneficiary. When a spousal RRSP is set up, the owner and annuitant of the contract is the person who benefits from the deposits to the contract. The person who made the deposits to the plan does not have ownership rights. The recipient of the deposits names the beneficiary. Example: Jill sets up a spousal RRSP in the name of her husband, Jack, and makes contributions to it. Jack is the owner and annuitant of the plan, and he alone can name its beneficiary. After a contract owner has died, the insurer may release information about a contract to the beneficiary and to the owner's estate. 6.2.1.3 Rider Election Form. The rider election is provided only to those contract owners investing in guaranteed minimum withdrawal benefits, GMWB. It specifies that the GMWB is being elected, provides a payment option, lifetime or to an end date, offers space to fill in the correct fund codes, must be those that offer the rider, describes minimum initial deposit requirements, gives a choice for payments, instructs on the frequency of payments and how they are made, establishes mandatory authorization by the owner and the agent. Just as the segregated fund contract addresses investment risk from the outset, so too does the rider address the impact of excess withdrawals from a GMWB because they can significantly reduce the value of the contract. The contract owner may not receive his expected amount in payments in the future if excess withdrawals have been made. 6.2.1.4 Client Identification Requirements. FINTRAC was established by, and operates within the scope of, the Proceeds of Crime, Money Laundering, and Terrorist Financing Act, PMELTFA, 33 and its regulations. The Financial Transactions and Reports Analysis Centre of Canada, FINTRAC, is Canada's financial intelligence unit, FIU. The centre assists in the detection, prevention, and deterrence of money laundering and the financing of terrorist activities. As discussed earlier, the agent has obligations under the PMELTFA to properly identify clients and to keep records about the client and the transaction if the client is expected to deposit $10,000 or more to the contract over its lifetime, or if a beneficiary will receive $10,000 or more over the duration of an annuity or policy. The agent must also determine whether the client is acting on instructions from a third party. The agent is also required to submit a terrorist property report under specified circumstances to FINTRAC. These requirements do not apply when the account is registered. Requirements are also specified for the agent if a large cash transaction is made as cash or a virtual currency, VC. A large cash transaction is a single cash deposit of $10,000 or more, or multiple cash deposits equaling $10,000 or more made in a 24-hour period. Note the specification. For cash. Cash means cash, notes and coins, not checks, not transfers, not a bank draft or other instrument. When an account is opened, reviewed, or a suspicious fact is detected, the agent has to confirm whether the client is a politically exposed foreign person, PEFP, a domestic politically exposed person, PEP, head of an international organization, HIO, or a family member or close associate of one of these people. In general, a PEFP is a person who has held a government or judicial position in a foreign country. A domestic PEP is a person who holds, or has held within the last 5 years, a specific office or position in or on behalf of the Canadian federal government, a Canadian provincial government, or a Canadian municipal government. An HIO is the head or chief executive officer of an international organization set up by the governments of more than one country. If the client is identified as being high risk, you have specific obligations for the client, his family members, and close associates that apply to record keeping, establishing the source of funds, and obtaining the approval of senior management to keep the account owner. FINTRAC has 3 methods to establish suitable client identification. Photo identification applies to individuals who are physically present. Must be issued by a federal, provincial, or territorial government. Name and photograph details must match. Must be valid, current and authentic. Must include a unique identifying number. A foreign-issued ID is acceptable if it is equivalent to the Canadian-issued photo ID. Documents. Some examples include a Canadian passport, permanent resident card, secure certificate of Indian status, provincial or territorial identity cards, a U.S. passport, a credit file. The file must have existed for at least 3 years. The name, address and date of birth must match the information provided by the individual. Providers include Equifax Canada and TransUnion Canada. Dual process. 2 original, valid and current documents or information from independent and reliable sources must be provided. Name, address and date of birth must match. Documents must be valid and current. 2 sources are used as follows. 1 source to verify an individual's name and address, such as a Canadian passport. And a second source to verify their name and date of birth, such as a birth certificate or permanent resident card. 1 source to verify an individual's name and address and a second source to verify their name and confirm a financial account, such as a credit card statement. 1 source to verify an individual's name and date of birth and a second source to verify their name and confirm a financial account. Ontario, Manitoba, Nova Scotia, and Prince Edward Island prohibit the use of their provincial health cards for identification. Corporations and other entities must also supply acceptable identification, such as the corporation's certificate of corporate status, and the names of directors. The agent must be completely confident that the person appearing in the identification papers is the same person making the application. If there is any suspicion that the applicant is acting for a third party, then a form for third-party determination must be completed. Any suspicious transaction or attempted transaction may be of interest to FINTRAC. Suspicious transactions are a combination of facts, context, and money laundering indicators. Facts are actual events, actions, occurrences, or elements that exist or are known to have happened. Context is provided through general awareness of events in the client's business or community. Knowledge of typical financial activities, regular know your client activities, information based on risk assessments and the background in/or behavior of a client. Indicators are potential red flags that could initiate suspicion or indicate that something may be unusual without a reasonable explanation. Suspicion itself has 3 thresholds. The lowest is simple suspicion, in which a hunch or gut feeling leads an agent to believe that money laundering or terrorist financing is happening. Next is when there are reasonable grounds to suspect that there is a probability of money laundering or terrorist financing. The highest threshold is when there are reasonable grounds to believe and support the probability that money laundering or terrorist financing is occurring. An attempted or completed suspicious transaction must be reported to FINTRAC. There is no monetary threshold to be met. If the agent is suspicious for good reasons, he must report the individual. The agent may wish to first bring the situation to the attention of a supervisor or manager. All members of the financial services industry have a responsibility to follow the FINTRAC guidelines in an effort to curtail, with the goal of eliminating, money laundering and terrorist financing. 6.2.2 Funding the account. A deposit must accompany the application. It can be in the form of a check made payable to the insurer for a lump sum, by transfer, or by providing the date on which the first pre-authorized deposit will be made. Pre-authorized deposits or debits, PADs, specify frequency, weekly, bi-weekly, monthly, bi-monthly, quarterly, semi-annually or annually, the date of the first withdrawal from the account, and the regular subsequent date for withdrawals. Banking information for the institution from which withdrawals will be made in a personalized void check or stamped confirmation from the bank must be provided. The deposit is allocated to the selected fund or funds. If more than one fund is chosen, the contract owner also indicates either the dollar amount of or percentage of deposit he wants applied against each fund. In some jurisdictions, when locked-in funds are being transferred, the spouse must give consent to the purchase of the investment. The spouse has the option to release his rights to the pension contributions and subsequent account to which those contributions are deposited by providing a written waiver form. An RRSP, Locked-in Retirement Account, LIRA, also called an LRSP or Locked-in Retirement Savings Plan, contract can accept deposits until the end of the calendar year in which the contract owner turns 71. To continue tax deferral, the RRSP can be converted to a registered Retirement Income Fund, RRIF, and the LIRA/LRSP converted to a Life Income Fund, LIF, or Life Retirement Income Fund, LRIF, or Prescribed Registered Retirement Income Fund, PRIF, for Saskatchewan and Manitoba pension plan members. If an account must be transferred from one form to another due to attained age, the insurer handles the change. The contract owner is set up in the proper account with the same fund and same unit value as prior to the switch. There may be a minimum value required to open an account and for different forms of account. These should be verified with the insurer. The investor is informed of the unit value for each deposit. This is true of single deposits and deposits made over time in a PAD plan. The unit value of the fund at the time of purchase forms a benchmark against which the future performance is monitored. 6.3 Agent Requirements. The agent is required to meet expectations of the client and the insurer he represents for pre-sale activities, completion of the application, delivery of documents and post-sale service. 6.3.1 Meeting carrier expectations. The agent is expected to meet all expectations of the carrier for volume of business, client contact, accuracy in dealing with the carrier and clients, and necessary record keeping. 6.3.2 Document delivery. The contract must be delivered to the investor in person or through registered mail for the purchase to be completed and the contract issued. It includes other specified documents like the information folder, fund facts, and contract confirmation. If a delivery receipt is part of the package of documents, it must be completed, signed, and witnessed before it is returned to the issuing insurer. Other forms may be required during the period the contract is in force if the client's situation changes or evolves, such as the change of beneficiary form and that used for a death claim. 6.3.2.1 Information folder. The information folder describes all the features of segregated funds and how they work. Specific fund details are provided in fund facts, which usually accompany the information folder. The purpose of the information folder is to provide brief and plain disclosure of all material facts relating to the IVICs issued by the insurer. One information folder is typically issued by the insurer for all the funds it provides, although every fund has a unique identifier code. This is helpful to the agent since it means all relevant information is put into the hands of the investor at the same time. There can be no omissions. An information folder may lead off with a summary of key facts, which is simply an overview of details provided again in the information folder itself. 6.3.2.2 Fund facts. Fund facts are the details of the particular funds offered by the insurer through its information folder. One is prepared for each fund as of December 31st of the preceding year. The information is presented consistently for every fund across all mutual fund companies so that comparisons can be easily made between funds. It is written in plain English to enhance client understanding. It is essential for the agent to review the fund facts for the funds he has recommended with the investor to ensure the investor understands the recommendation and to answer any questions. 6.3.2.3 Confirmation. Confirmation by the investor is required to finalize purchase, switch funds, reset, withdraw money from the contract, terminate the contract. Confirmation may be provided to the investor electronically or in writing. On occasion, the client may be given the opportunity to provide instructions to the insurer verbally. These instructions are as binding as if they were written. 6.3.3 Ongoing service requirements. Sales activity for a segregated fund contract does not end with the confirmation of purchase. The wise agent recognizes the confirmation as just one step along the path of providing exemplary customer service. 6.3.3.1 Post-sale follow-up. The agent should follow up with the client once the sales process is completed to see whether he is satisfied with the product and to answer any questions that may have arisen. Keeping the lines of communication open between client and agent reinforces the agent's value to the client and can help to pave the way for additional business or recommendations. 6.3.3.2 Need to monitor client. The agent needs to inform the client that he must notify the agent or insurer of changes to his personal situation that might affect the contract in place. Such a change may be the need to change the beneficiary. The agent should also periodically check that all information, such as the client's address of residence, is up to date. It would also be important to know if financial affairs of a client have transferred over to a power of attorney, POA, in which case the client could no longer provide directions for the contract. 6.3.3.3 Need to monitor product. New segregated funds are introduced continually, others are combined, and others are discontinued. Agents need to know their products well and keep on top of changes, such as a change in portfolio manager or the management expense ratio, MER, that may have a direct bearing on performance. Significant changes to a fund should be communicated to the client immediately, and this is usually done by the insurer rather than the agent. However, the agent may wish to reinforce the impact, or lack of impact, of any changes to the client. If there is a substantial loss in value of a fund, the client must be informed. Although no one likes bad news, providing the information shows that the agent is monitoring the fund and can answer questions and concerns that may arise as a consequence. 6.3.3.4 Annual review. At a minimum, the agent should meet in person or virtually with the client once a year to review the selected investment and its performance. The agent should be prepared to discuss the return since the last review, whether good or bad, expectations, and his understanding for the reasons underlying performance. He should use this opportunity to check with the client as to whether there are changes in his personal situation of which the agent should be aware. This is also a time to ensure the investor is aware of any significant changes that have occurred in the fund if applicable. 6.3.3.5 Handling deposits. When a check accompanies the application, it must be handled securely and immediately sent to the insurer. There is no room for error in the handling of money and any other banking information. The check should show the contract number to which the payment is to be applied. 6.3.3.6 Making a fund switch. A fund switch is a change in investment from one fund to another. Units are sold and the money used to purchase units in the other fund. Fund switches may be scheduled or unscheduled. An unscheduled switch is simply made by request to the agent or insurer. The switch may be requested because the investor wishes to rebalance the account or is dissatisfied with fund performance, for instance. The request can happen at any time. A minimum amount is required for The switch and the minimum balance for the fund must be met. Each insurer provides a number of switches a year for free. A withdrawal fee may be charged when switches exceed this limit. Some switches will not be allowed depending on the sales charge or contract guarantees. It is also possible for a switch to act as a reset that changes both the maturity date of the contract and contract guarantees. If units are switched within 90 days of purchase, a short-term trading fee may be charged or the switch may not be permitted. A short-term trading fee is a charge against the value of the fund, e.g. 2%. The information about the amount of the fee is in Fund Facts. A scheduled switch is one set up on a regular basis, such as at the end of every year. There is no need for the client to make the switch request in this case. Fees are not charged when switches are scheduled. However, the insurer can cancel the switches or redirect switched funds. If this occurs, the investor will be notified in advance and provided with options for the future. A capital gain or loss can be incurred by a switch to the extent the amount switched exceeds or is lower than the adjusted cost base of the units. 6.3.3.7 Resets. Similar to switches, a reset to a higher account value based on market value can be scheduled or unscheduled. However, unlike switches, not all funds allow reset to occur. When a reset is completed, the maturity date of the contract resets. For 10-year contracts, the new maturity date will be 10 years from the reset date. Some insurers limit the age of the investor, or annuitant, at which a reset can be made, for instance to age 80. A reset at 80 would schedule contract maturity for age 90. The mortality rate in the years between 80 and 90 is very high, so the insurer would very likely have to meet the death benefit guarantee obligation. If the death benefit is higher than market value, the insurer must make the top-up. This could become costly for the insurer. An unscheduled reset is used by an investor to lock in a gain when he sees the value of his units have increased. The contract owner informs the agent or insurer of his wish to reset the contract and the request is processed. The number of resets per year may be limited by the insurer. Therefore, an investor could miss a market high if he has expended his allotment of resets for that year. However, attempting to time the market is rarely successful, far better to try and achieve steady modest gains in reset. A scheduled, or automatic, reset may be restricted to the schedule set by the insurer, such as twice per year. No instructions from the contract owner are required. The reset is done only if the market value of the investment is higher than the unit's deposit value. 6.3.3.8 Change of beneficiary. Although the beneficiary is specified in the application, the need may arise to change the beneficiary if, for instance, the beneficiary dies or the contract owner decides a new beneficiary is in order. This can be done at any time by the contract owner providing the beneficiary designation is not irrevocable. Naming a contingent beneficiary is always a good practice. The contingent beneficiary becomes the primary beneficiary if the primary beneficiary dies. This addresses a situation in which the annuitant and primary beneficiary die at the same time. A revocable beneficiary can be changed by the contract owner at any time in a written request to the insurer or by completing a change of beneficiary form. An irrevocable beneficiary can also be changed if the beneficiary consents. When the beneficiary is changed, the insurer must be notified in writing. The change will be effective the date of signing. 6.3.3.9 Renewing a contract. At the 10-year maturity of the contract, its value may be taken as cash or in the form of an annuity, or renewed for another period. When renewed, a new guarantee period begins. The new maturity date depends on the age of the annuitant when the contract is renewed. The initial contribution to the renewal contract is the total market value or the guarantee if the market value is lower. The death benefit guarantee continues. The agent will be involved in recommending the renewal and ensuring proper documentation is prepared and delivered to the insurer in a timely manner. 6.4 Claims. The claim for value of a contract can be made by the contract owner for withdrawal, surrender and maturity, by a beneficiary or an estate trustee, or equivalent, at death, by the person in control of the contract, when a POA for property is invoked, for withdrawal, surrender and maturity. The claim sees the value of the contract or specified sum, if a withdrawal, paid minus any outstanding charges or fees. The agent should not attempt to calculate the amount that will be paid since he may be unaware of enhancements to or charges against the contract. 6.4.1 Claims Process. The process for claims does not have to involve the agent since forms can be ordered directly from the insurer. However, the agent may choose to be involved to provide customer service to his client. 6.4.1.1 Claim Forms. Both withdrawal and death benefit claim forms can be ordered directly from the insurer. They must be returned completed and signed with any attachments and information the insurer specifies. Once forms are submitted, an insurance representative specializing in claims takes over handling the claim and issuing a check or checks, or ensuring funds are transferred as requested. 6.4.2 Types of Claims. Both tact and sensitivity are called for when the agent is involved in a death claim. Other types of claims are simply financial transactions that call for efficiency and privacy. A high degree of professionalism is expected from the agent who chooses to be involved in claims. Different types of claims are discussed in the following sections. 6.4.2.1 Maturity Claims and Death Claims. The maturity guarantee is claimed when the contract has matured, by the contract owner or person acting as POA for property. The death benefit guarantee is paid at death of the annuitant to the beneficiary. Both guarantee amounts are contractually obligated as a percentage of deposits, adjusted upwards by any resets and adjusted downwards by any withdrawals from the contract. If the market value of the account is not equivalent to the guarantee, the insurer will step in and contribute a sum equal to the difference between market value and guarantee. The declaration of death is made by the beneficiary or estate trustee, who may be an executor, administrator or liquidator, in Quebec. The contract number is provided in addition to the signature of the claimant and the agent's name and number. Proof of death or the attending physician's statement, APS, is required. The death claim must be accompanied by an original death certificate. Additional documents may be required especially if the death occurs outside the country. 6.4.2.2 Termination and Surrender Claims. Termination occurs at contract maturity, surrender occurs before the contract has matured. Both activities constitute a claim and terminate the contract. A contract may be terminated at any time by completing the withdrawal form providing the contract has not matured and annuity payments have not started. The contract owner at termination may choose to receive the value of the contract in cash, to buy an annuity, or another option provided by the insurer. Locked-in accounts may be restricted as to whether the cash can be received and their value may have to be transferred to another locked-in account depending on the legislation of the province that applies to the funds. 6.4.2.3 Withdrawal Form. The request for a withdrawal is initiated by the contract owner. The withdrawal form is used to both close the contract by withdrawing the total value of the account, and to make a partial withdrawal. As discussed in the preceding chapter, charges may apply and the client must specify if the amount he wishes is net of charges, i.e., the actual sum he will receive, or the gross amount. The form requires contract owner information, identification of contract type, selection of withdrawal options, selection of form of payment, i.e., check, direct deposit, or transfer to another product or institution. Instructions to set up a scheduled withdrawal plan, SWP, for instance when payments from a RRIF must begin. Selection of fund, by its number, from which the withdrawal is to be made. Specified amount to be withdrawn. Signature of contract owner and irrevocable beneficiary if one exists. Signature of agent with a date and time for client instructions. Withdrawal options cover many circumstances beyond a partial or full withdrawal. The contract owner can also choose to set up or change a scheduled payment plan. Change the amount or date of scheduled payments. Change the allocation of scheduled payments. Change the banking information for scheduled payments. Stop the scheduled payments. A minimum amount of annual withdrawal is required when the contract is a RRIF. When the contract is a LIF or a Restricted Life Income Fund, RLIF, it must be more than the annual minimum and less than the annual maximum. 6.4.2.4 Power of Attorney, POA, Claim. A power of attorney, POA, for property document appoints another person to act as a substitute decision maker for all matters pertaining to the contract owner's property when the contract owner is unable to do so. As previously discussed, the individual granted POA for property controls the contract except, possibly, for the naming of beneficiaries. The instructions for withdrawals or surrender made by the person with POA for property must be respected and acted upon, as if he was the contract owner. If the agent has reasons to suspect the person with POA is not acting in the best interests of the contract owner, he should discuss this with his manager or supervisor. 6.4.3 Factors affecting claims. The amount received in a claim may not be the amount anticipated by the contract owner. He must fully understand the effect of withdrawals, sales charges, guarantees and allocations. 6.4.3.1 Maturity and Death Benefit Guarantee. The amount received at maturity or death can exceed the guaranteed amount when the market value of the contract is higher than the guarantee. However, if withdrawals are made from the contract during its term, guarantees are adjusted downwards in proportion to the account balance. The timing of the maturity guarantee can also be affected when reset is used. 6.4.3.2 Allocations. When a segregated fund generates interest, dividends, capital gains, or other sorts of income, that income remains in the fund and is reflected in its unit value. This investment income and these capital gains or losses are allocated to investors annually. This allocation increases or decreases the adjusted cost base, ACB, of a non-registered investment. Consequently, this income is not taxed again upon withdrawal. Chapter 7. Annuity Contracts. Competency Components. Implement a recommendation adapted to the client's needs and situation. Provide customer service during the validity period of the coverage. Competency Subcomponents. Confirm the requirements that must be met to implement the recommendation. Validate the appropriateness of contract amendment, renewal, and termination applications. In regards to the client's situation, inform the claimant of the claims process. 7. Annuity Contract. Like all binding agreements that a life insurance agent has a role in creating, the annuity contract must be prepared with care. There are restrictions that the investor must understand before finalizing his purchase, especially for a payout annuity, because of the commitment the investor makes and the restrictions that apply. The agent needs to be absolutely sure the investor understands what to expect and what he will receive. Many of the principles of the annuity contract are the same as the individual variable insurance contract, IVIC, discussed in the previous chapter. They include the attention to detail and professionalism required of the agent throughout the process of application, delivery, ongoing service, and claims. 7.1 Contract. Life annuities and term annuities sold by insurers are insurance policies. Policies are contracts that form a legal relationship between the client and the insurer. Certain terms in the contract, called general contract provisions, can apply to all policies while other terms will be specific to the type of policy issued. Just as payout and accumulation annuities vary widely in their structure and purpose, so too will the contracts for each type of annuity be very different. A contract for a payout annuity is a commitment for a specified term or life. When the contract has been issued, it is final. No changes can be made except to change the person named as beneficiary. A free look period applies after the contract is issued, during which time the annuity can be cancelled. Thereafter, the investor cannot rescind the contract to receive a refund of his investment. The annuity rate that applies to the premium or premiums deposited by the investor applies for the duration of the annuity. If an annuity rate has been quoted and used in an illustration of the income to be paid by the contract for an immediate annuity, that rate may be guaranteed for a period of time by the insurer. If there is no guarantee, income is calculated on the annuity rate in effect on the date the single or last of multiple premiums is received. A payout annuity application specifies that income payments are made based on the annuity rate. In effect, the type of annuity chosen and the frequency of payment selected in the application. The contract confirms this information. The accumulation annuity contract has provisions that apply before the contract's maturity date and on or after the maturity date. It includes how interest is calculated and paid on the premium, minimum and maximum withdrawal limits, and how the contract is terminated. Amendments and addendums can be attached to a contract. These customize the contract according to an individual's particular circumstances or needs. An amendment may be used to waive a contract provision, or to correct an error or omission. It is valid only when it is prepared in writing by the insurer and signed by the investor. As with all applications for insurance products, the agent must ensure all information is provided accurately to the insurer for the contract to be prepared correctly. The agent must be able to answer all investor questions clearly and factually. Uncertainty about any aspect of the future contract requires the agent to contact his manager or supervisor for clarification, or the insurer issuing the contract. Addressing investor questions as they arise means the agent develops a robust understanding of the product that can be used in future dealings with other investors. In this way, the agent builds a solid basis of product knowledge that, coupled with understanding investor needs, allows the agent to provide exemplary service. 7.2 Investor Requirements. The investor has two general requirements for both the payout and accumulation annuity contract. To assist the agent by providing all required information for the application form to be completed. To fund the contract. Each form of contract also has specific requirements. The payout annuity contract directs the investor to select a schedule for payment with details of the financial institution and account where payments are to be made. The accumulation annuity contract requires its owner to make choices that center on its term for investment. 7.2.1 Application Form. There are significant differences between the application forms of insurers issuing annuities. Some incorporate all required information in the application itself, and the application is multiple pages in length. Other applications appear to be much shorter, but they rely on the agent to complete additional forms that must be attached with the application itself to make it complete. The wording of applications varies widely. Both applications for the two types of annuities, payout and accumulation, are very different, and each insurer uses wording specific to its particular product. Often, an application includes definitions of terms that appear in the document. They should be reviewed by the agent with the investor to ensure mutual understanding. Like the IVIC for segregated funds, the annuity application form is completed by the agent and investor together, whether virtually or in person. The application may be provided online by the insurer or in a printed format. The investor must be accurate and truthful in the information he provides. It is the investor's decision to follow the recommendation of the agent or to make his own choice of annuity product. The recording of the information in the application should not be rushed. The agent needs to Manage his time to allow the application to be completed with the investor in one sitting. He must not take away a partially completed application to fill in the missing details on his own. Every application form needs to be carefully reviewed prior to meeting with the investor, as it is being completed, and after it has been signed and is ready for submitting to the insurer. A mistake could be made while completing the application. When an application is in print form, a change can be made to correct an error, and both the investor and the agent initial the change as close to the changed information as possible. This is evidence that both parties acknowledge and agree to the change. A change to an online application can be made prior to submitting the document simply by deleting the incorrect information and inputting that which is correct. Consequently, the online application must be read with great attention to detail prior to transmitting in electronic format. An agent must never assume the application is correct. He must ensure it is by carefully reading all information, including correct spelling of names and data copied from documents, such as a birth certificate. Again, like the IVIC, an annuity application could be completed by a person who has power of attorney, POA, for property for another. Legal guidance is required if the person acting in the role of POA decides to name a beneficiary. Neither the agent nor the investor has the right to modify, cancel, or waive any question on the application. Doing so can void the application. An application is not finalized until it is accepted by the insurer. As with the application for a segregated fund, a reason why letter is prepared and reviewed with the client when the application is submitted. This letter does not confirm that the policy has been issued, it paraphrases what the agent has learned from the proposed client, confirms what was discussed and when, and sets out the plan of action. It substantiates the reasons why the annuity is suitable for the client's needs. The letter must be easy to understand and brief. After the agent has reviewed the letter with the client to ensure its accuracy and gather his agreement with the proposal, he should make a copy for his client file and for the client. 7.2.1.1 Registered or non-registered annuity. A contract may be issued for a registered or non-registered annuity. The contract owner and annuitant must be the same person when the annuity is registered. The registered contract is subject to all rules set by the Income Tax Act, (ITA), for registered accounts, which include the age at which income may be paid from the account, requirement for a minimum withdrawal, withholding tax on withdrawals, what happens to the account if the account owner dies. All withdrawals from registered accounts must be declared for tax purposes in the year in which they are made. A non-registered account is not subject to Canada Revenue Agency, CRA, rules for contributions, withdrawals, or tax deferral. However, it is subject to the rules set by the insurer issuing the contract. A non-registered annuity may be taxed in a prescribed or accrual, non-prescribed, form, while the prescribed form is preferred because the interest component of each payment is level over the life of the annuity. The many criteria for a prescribed annuity, some of which are described in Chapter 3, must be satisfied. 7.2.1.2 Naming annuitant and beneficiary. This is a straightforward part of the application in which the owner names his choice for annuitant and, if applicable, primary beneficiary and contingent beneficiary. The agent must note the following. The owner and annuitant must be the same person if the annuity is registered or funded with registered savings. Two annuitants must be named in a joint annuity, the annuitant and the joint annuitant, also called the co-annuitant. The joint annuitant becomes the only annuitant when the first annuitant dies. The beneficiary does not receive any proceeds until the death of the second joint annuitant, and then only if the contract is structured with a guarantee period. A beneficiary must be named in the application when there is a guarantee period unless the annuity is a life annuity with no guarantee period. When no guarantee period exists, a beneficiary is not named and cannot be added to the contract at a later date. When some, or all, of the premium is derived from a locked-in pension, all or part of the death benefit may become payable to the spouse instead of the beneficiary. In this case, the spouse's information must be provided unless the spouse has waived his rights to the benefit in a spousal waiver form. As in all insurance contracts, the beneficiary can be designated as revocable or irrevocable. The owner must understand the restrictions on the policy when an irrevocable beneficiary is named. Foremost among these is the inability to change the beneficiary unless the irrevocable beneficiary provides consent to do so. A contingent beneficiary can also be named in the application. He becomes the beneficiary if the primary beneficiary has died before the annuitant. A contingent beneficiary is always revocable. 7.2.1.3 Owner Identification Requirements. Identification requirements for the owner of a segregated fund contract are described in the previous chapter for compliance with the Proceeds of Crime, Money Laundering, and Terrorist Financing Act. They are also true for the owner of an annuity contract. There are two exceptions to identification requirements. Identification requirements do not apply when an immediate or deferred annuity is funded by a transfer from a registered pension plan or proceeds of a group life insurance policy. The contract is registered. The owner of an annuity contract must also provide evidence of the age of each annuitant. If the owner is a legal entity, its identity must be confirmed by specific documentation. 7.2.2 Funding the contract. Funding for the contract takes two fundamental forms: a new cash, or equivalent, deposit or transfer of existing savings. Sources of funds include direct deposits from accounts and transfers made from both registered and non-registered savings, personal savings or checking account, bonds, guaranteed investment certificates, GICs, tax-free savings accounts, TFSAs, stocks, mutual funds, and segregated funds. Registered Retirement Savings Plan, RRSP. Registered Pension Plan, RPP, contributions to a Defined Contribution Pension Plan, DCPP, or Recognized Participation Amount from a Defined Benefit Pension Plan, DBPP. Registered Retirement Income Fund, RRIF. Locked-in Retirement Account, LIRA. Life Income Fund, LIF, or Locked-in Retirement Income Fund, LRIF. Deferred Profit Sharing Plan, DPSP. Prescribed Retirement Income Fund, PRIF. Restricted Life Income Fund, RLIF. Example 1. Louise, 62, receives a severance package from her employer including a check for $45,000. Instead of seeking another job, Louise decides to retire. She decides to buy an immediate life annuity, with a 25-year guarantee period that will provide income right away. Louise has significant RRSP contribution room due to unused contribution room in previous years. With the help of her agent, Louise sets up a registered annuity with the $45,000 she received after having deposited this amount in an RRSP. This RRSP contribution is tax deductible. The payments she will receive as annuitant of the policy will be fully taxable in her hands. Example 2. Sam, age 62, is tired of playing the stock market and decides to stabilize his invested money in an accumulation annuity. His money is held in an RRSP at an investment broker. In his annuity application, he specifies the money held by the broker be transferred into a registered annuity. This is not considered a new contribution, so there are no tax implications. Sam can continue to deposit to the account up to the authorized contribution limit, and these subsequent contributions are tax deductible. All payments Sam eventually receives from the annuity after it is converted to a payout annuity, comprising both the amount transferred and the amounts subsequently deposited, are fully taxable in his hands. 7.3 Agent Service Requirements. Time brings change. Once the contract has been delivered, the agent should view the service he can provide to contract owners as an ongoing activity, to both ensure changes are accommodated in the contract as necessary and to be alert for other product sales opportunities. An outstanding service opportunity exists for agents who have clients with RRSPs that are maturing, or the clients are members of a DCPP who must transfer their retirement savings when they leave their employer. RRSPs may be held at the same financial institution with which the agent is affiliated or others. One of the options available to all owners of an RRSP is to convert the value of their plan on maturity to a term to age 90 annuity or life annuity to continue tax deferral. If an annuity is a suitable choice, as determined by the needs analysis, the agent has provided a valuable service to the client by presenting this option. Also, a client may have more than one RRSP that is maturing. The client may be best served by conversion of one RRSP to an annuity and conversion of another RRSP to a RRIF to continue tax deferral. As discussed previously, members of DCPPs must transfer the value of their savings at retirement to an account that will pay an income. Agents can offer LIF/LRIF/PRIF/RLIF accounts and assist the retiree with investment and income choices. Although annuities have been eclipsed in popularity by the RRIF, which is based primarily on investment in GICs and mutual funds, they are valuable as a maturity option due to their dependability as a source of guaranteed income. There is also no need for account management or ongoing decision-making as there is with a RRIF account. If interest rates stay at the higher level they attained in 2022 or rise further, there may be renewed attention paid to annuities since annuity rates should become more attractive than when interest rates were low. 7.3.1 Contract delivery. Contracts are not necessarily delivered in person by the agent. An insurer may mail or courier the contract to its owner. However, when it is possible and safe for the agent to deliver the contract, he then has a chance to once more reinforce the value of the product purchased and answer any further questions. 7.3.2 Ongoing service requirements. For the agent, servicing the annuity contract centers on ensuring the beneficiary designation remains true to the owner's intention and, for an accumulation annuity, possibly receiving deposits and managing maturity of the contract to determine whether conversion to a payout annuity would be appropriate. 7.3.2.1 Change of beneficiary. A beneficiary may be replaced by another because the contract owner changes his mind or because the named beneficiary has died. The contract owner can name whom he likes providing the beneficiary is revocable and there are no restrictions on the contract because it has been funded by a transfer of locked-in funds from a registered pension plan. A change of beneficiary form is completed by the contract owner and signed to effect the change. When it is submitted, all previous beneficiary designations are revoked. The completed form must be sent immediately to the insurer. 7.3.2.2 Handling deposits. Deposits may be received by the agent as cash, a check, or bank draft. All deposits must be handled securely and forwarded to the insurer without delay. As discussed, cash deposits may be a transaction that falls under anti-money laundering legislation, Proceeds of Crime, Money Laundering, and Terrorist Financing Act. The agent will be familiar with those rules and follow them closely to ensure compliance. The agent should provide a receipt to the client for any cash he receives as a deposit. Checks and bank drafts are made payable to the insurer. If the contract has been assigned a policy number, that number should appear on the check. The agent has to take every possible step to make sure a deposit is not stolen or lost while in his possession. It must not be left in a briefcase or purse in an unoccupied vehicle, for example, and it should be stored under lock and key in the office, even for brief periods of time. 7.4 Claims. A claim is made to receive some or all of the funds held in a contract. The person who makes the claim is known as the claimant. The claimant may request help from an agent or the agent may Volunteer to assist. A claim that is submitted properly, including necessary attachments, will speed up processing. 7.4.1 Claims Process. The agent may provide the necessary claim form or information on how to obtain the claim form, documentation that must accompany the claim, where the claim form must be sent for processing. A claim form must be complete and include the claimant's signature for processing to begin. The agent may assist in preparation of the claim, but once the claim is submitted to the insurer, it is taken over by a claims representative and the agent is no longer involved. The representative issues a check or checks, or transfers funds as requested. 7.4.2 Types of claims. Payout and accumulation annuities may see a claim on death of the annuitant if a beneficiary is entitled to proceeds. A claim may be made by the contract owner for withdrawal or surrender of a term annuity or an accumulation annuity. Example: Douglas has an RRSP that is maturing. He chooses a term annuity to age 90 as the option most suitable to his needs during retirement. He names his 4 children as equal beneficiaries of the contract. Douglas receives a monthly income from the annuity. When he dies at age 86, his children share equally the balance of the contract. If the primary beneficiary has died prior to the annuitant, a contingent beneficiary may receive proceeds. If no living beneficiary exists, the claim is then made by the executor of the estate of the annuitant and paid to the estate of the annuitant. In provinces where they exist, probate fees could then apply since the proceeds become part of the value of the estate. No probate fees apply when a named beneficiary of an annuity contract receives the proceeds of the contract. Example: Catherine received a monthly annuity payment from a life annuity with a 25-year guarantee period purchased by her husband before he retired from his senior-level executive position. He wanted to supplement her old age security OAS benefits, so the annuity started when Catherine was 65. Since Catherine and her husband have no children, the annuity named Catherine's sister, Norma, as beneficiary. Catherine's husband died several years ago and Norma died last year. Because Catherine suffers from advanced memory loss, she did not remember that she has an annuity and that Norma was its beneficiary, so she did not name another beneficiary. When Catherine died this year, there was no beneficiary named in the contract to receive the benefit of the guarantee. Consequently, the balance of the annuity guarantee was paid in a cash refund to Catherine's estate. 7.4.2.2 Transfer of annuitants in joint contract. A joint and last survivor annuity contract names both a primary annuitant and a second, or co-annuitant. The primary annuitant receives payments from the annuity for his lifetime. After his death, the second annuitant receives payment for life from the annuity. The switch is initiated when proof of death of the primary annuitant is provided to the insurer. 7.4.2.3 Surrender and withdrawal claims. An accumulation annuity has flexibility that a payout annuity does not. The annuity permits both withdrawals, subject to minimum and maximum amounts, and surrender. When the accumulation annuity is cashed in prior to its maturity date, a market value adjustment (MVA) may be made by the insurer, which penalizes the contract owner by reducing the sum he receives. The amount of reduction due to the MVA is based on the amount of time remaining in the term of a guaranteed investment after the withdrawal or surrender, the interest rate at the time the investment was made, the current interest rate, and fee. A surrender can be made at any time from an accumulation annuity. A term annuity may also be surrendered. In both cases, a penalty will be charged by the insurer according to contract terms. A life annuity may not be surrendered once annuity payments have started. When a claim for surrender or withdrawal is made, it must in a form acceptable to the insurer. 7.4.2.4 Power of Attorney, POA, Claims. A person acting in the position of power of attorney, POA, for property may have a special form to complete as a third party in respect of the account. Again, the insurer will provide the proper form for use. 7.4.3 Factors affecting claims. When applicable, taxes are always withheld by the insurer according to the rules set out by the Income Tax Act when a contract is surrendered or a withdrawal is made. The amount received from the claim and how it is paid will depend on whether a cash refund or installment refund has been chosen to protect annuity capital for the beneficiary of a life annuity, and whether a guarantee period is in place. A claim cannot be made against a life annuity unless a guarantee exists. The beneficiary is entitled to the portion of the contract not paid to the annuitant representing the period between the start of payments and the end of the guarantee, or the difference between the initial capital invested and the payments made up until the annuitant's death. The beneficiary has no further claim after the guarantee period ends. Example: Tara, at age 66, purchased a life annuity, paying $3,000 a month, with a 20-year guarantee period, and named her adult son, Rob, as the beneficiary of the annuity. Tara died 10 years later. Rob, as beneficiary of Tara's annuity, will keep getting $3,000 a month for 10 years, i.e., until the end of the 20-year guaranteed period. Chapter 8. Group Retirement and Investment Plans. Competency Components. Assess the client's needs and situation. Analyze the available products that meet the client's needs. Implement a recommendation adapted to the client's needs and situation. Provide customer service during the validity period of the coverage. Competency subcomponents. Determine the client's situation, investment objectives, and investor profile. Assess the appropriateness of the client's existing coverage in regards to his or her situation. Analyze the advantages of segregated funds in comparison to other types of investments in regards to the client's needs. Analyze the types of group retirement and investment plans that meet the client's needs. Propose a recommendation adapted to the client's needs and situation. Confirm the requirements that must be met to implement the recommendation. Validate the appropriateness of contract amendment, renewal, and termination applications in regards to the client's situation. Inform the claimant of the claims process. 8. Group Retirement and Investment Plans. The previous chapters in this manual have focused on investing products and plans for a single client, or a client that is a couple, and the role of the life insurance agent working with such individuals. In this chapter, the focus changes. The agent now becomes a service provider to a group sponsor or administrator, and it is the group sponsor or administrator that is the client. The agent works with that client to achieve its objectives with the group it represents. The group itself may be as small as a few people or number in the thousands. The group sponsor or administrator may have sought the expertise of the agent for other insurance products, such as group life or accident and sickness coverage. However, when the objective is savings and investment, typically for retirement income, the sponsor or its administrator then seeks the agent's recommendation for an appropriate plan. The sponsor who offers such a plan is making a commitment to the group members, and this commitment cannot be undertaken lightly. There are both considerable financial obligations for the sponsor and administrative costs incurred when a group plan is offered. The sponsor's rewards are the appreciation of the group members for the benefit the plan provides and the loyalty the plan engenders. This helps the employer retain its employees and avoid the expense of higher employee turnover. The plan may also enable the sponsor to attract employees. In order to provide sound advice to a sponsor or administrator, the agent must be familiar with many aspects of group plans, including group structure, plans available, including the client's existing plan, if applicable, investment options, recommendation process, group documents, service requirements, claims process. 8.1 Group Plan Structure. A group plan is comprised of its sponsor, its administrator, its members, and its insurer. The agent must be aware of the rights and responsibilities of each to ensure he provides appropriate service. 8.1.1 Group Plan Sponsor. A group plan is established and registered by its sponsor, usually an employer, with Canada Revenue Agency, CRA, and the provincial authorities concerned when it is a registered pension plan, RPP. It is subject to the requirements specified in applicable provincial pension benefits legislation. This includes compliance with filing certain reports, the possible need for an auditor's report, actuarial reports, and other reports as required by the jurisdiction in which the group plan is registered. Alternatively, some group pension plans are federally regulated and are not subject to provincial legislation. They are provided to employees who work in an industry that is federally regulated, such as banking. Registration with CRA ensures that the annual maximum registered retirement savings plan, RRSP, contribution limit is not exceeded since registered pension plan, RPP, contributions by an individual reduce the amount that he can contribute to an RRSP. 8.1.1.1 Role of Plan Sponsor. The sponsor's role in providing the plan to its group members is to design the pension plan according to its needs, yet within the sponsor's financial limitations. Set the benefit structure for members. Establish, amend, or terminate the plan. Ensure compliance with regulatory requirements for reporting. Address funding shortfalls or surpluses. Final decisions about a group plan will be guided by the administrator and the life insurance agent, but are, in the end, the responsibility of the sponsor. 8.1.1.2 Funding commitment by plan sponsor. A sponsor takes on the financial commitment to fund the group plan as a joint contributor with the group members, or alone on behalf of the group members. When the sponsor and the group member both contribute to a plan, it is said to have contributory funding. Defined benefit pension plans, DBPPs, defined contribution pension plans, DCPPs. Group registered retirement savings plans, GRRSPs, and pooled registered pension plans, PRPPs, may all be contributory. When the sponsor alone contributes to a plan, the plan is non-contributory. A deferred profit sharing plan, DPSP, is non-contributory. Other plans may also be non-contributory if the sponsor makes the decision to forego employee contributions. When a plan has contributory funding, group member contributions are made through payroll deduction. Therefore, the contribution is made before take-home pay is received. Contributory plans may see the sponsor offer a matching formula in which the sponsor bases its contribution on the one made by the group member. The sponsor can match 100% of the members' contribution, in other words a dollar-for-dollar contribution, or it can be a different percentage. The matching formula can be structured to increase over time. In this case, the matching contribution increases the longer the employee works for the employer. This can decrease employee turnover and employee loyalty is rewarded. Reward employees based on their value to the sponsor. In this case, the matching contribution can vary for different categories of employees. Therefore, the most valuable employees are more highly rewarded for their service. Create loyalty. The matching contribution may apply after an employee has worked through a defined waiting period. This helps to retain employees and discourage new hires from seeking other employment opportunities. Matching contributions can be changed or stopped at any time if they are not a condition of an employment contract or collective bargaining agreement. The vesting provisions of a plan also impact funding requirements for the sponsor. Vesting describes who owns the sponsor's contributions to an employee's plan. During a period of time called the vesting period, an employee who changes jobs does not retain the sponsor contributions to his group plan. The employee retains only the contributions he made. However, at the end of the vesting period, the sponsor contributions become the property of the employee. In some cases, vesting is immediate and the employee retains both his and his employer's contributions when he leaves. A shorter vesting period is more expensive for the plan sponsor because his contributions could leave with the departing employee after the briefer period of time. Each jurisdiction establishes its own vesting period. 2 years is frequently considered typical, but vesting may be immediate or as long as 3 years. Example: Natalie begins her new job on September 1st. Her employer plan, a defined contribution pension plan, DCPP, has a 6-month waiting period. On March 1st, her plan begins with a contribution made by Natalie, deducted from her payroll, and a 100% matching contribution by her employer. The plan has a 1-year vesting period. If Natalie changes employers before the end of the vesting period, she will retain the contributions she made to the plan. As for her employer's contributions, they will be retained by the employer. However, if she leaves after 1 year, Natalie will retain both her contributions and those made by her employer. Natalie may be able to transfer her pension plan savings to her new employer. A locked-in retirement account, LIRA, is another transfer option available to her. If she decides on transferring to a LIRA, she can be in charge of the savings and will have investment options of her choosing available instead of being restricted to those offered within a group plan. 8.1.2 Group Pension Plan Administrator. The group pension plan sponsor appoints the person or entity that is plan administrator. In Quebec, for example, group plans containing more than 25 members must be administered by a pension committee. In many plans, the sponsor is also the administrator. When the employer acts as the plan administrator, it must take into account the best interests of the plan's beneficiaries and not act solely in its own best interests. The pension plan administrator has financial and administrative functions. Those functions are performed by resources in the organization, such as human resources, or accounting, or a third party. When a third party is used, it is typically a firm that specializes in employee benefits and services. The agent works closely with the administrator throughout the entire process: proposal, recommendation, implementation, and follow-up. For a DCPP, the role of administrator may be assumed by the plan sponsor, a board of trustees, a financial institution, for a simplified pension plan, or a pension committee as defined by pension benefits standards legislation. 8.1.2.1 Role of Group Pension Plan Administrator. The administrator is responsible for overall administration of the pension plan, including management of the pension plan, establishing a written statement of investment policy, investing the fund assets in accordance with that policy, creating and distributing other plan documents, acting in accordance with applicable legislation. The foremost task of the administrator is to administer the plan in accordance with the act that governs the plan and its regulations. The administrator has a fiduciary duty to plan members. To fulfill that duty, he must act honestly, in good faith and in the best interests of members, former members, and others involved in the plan. The administrator must also use the care, diligence and skill that a cautious person would exercise when dealing with the property of another person. The administrator knows the size and composition of the group and its needs. He is involved with the employer's payroll department in order to make any deductions required for the group pension plan by its members. He also describes the benefits of the group pension plan to job applicants and reinforces those benefits to members of the group. The administrator enrolls new members and withdraws members who quit the company or retire. He is also the person group members can turn to for information, to initiate claims or to process withdrawals when he is changing jobs or retiring, or when changes are required. The administrator is also responsible for measuring employee satisfaction with the plan, monitoring industry trends, governance guidelines, and legislative changes to keep the sponsor Apprised of new developments. Suggesting potential plan and investment recommendations. Assisting with plan sponsor governance activities. Reporting to the sponsor. 8.1.2.2 Data provided by Group Pension Plan Administrator. The administrator provides the data about the composition of the group to the agent to enable an application to be completed. He has access to the records of all members and is, thus, privy to sensitive financial details. This information is protected by privacy legislation and must be kept highly secure. The Group Plan Administrator ensures all the necessary information is provided to group members about the plan and their membership in the plan through the pension statement regularly provided to them. The statement details can include type of plan, amount deposited to the plan, accumulated earnings, account balance of the member, investment allocation, net return on the account for the period covered by the statement, current years of service, projected pension payable, normal retirement date, earliest retirement date at which an unreduced pension may be received, beneficiary details. The statement also specifies that projections are estimates based on information provided by the sponsor and the actual terms of the pension plan are outlined in official bylaws. When a group plan member leaves the group, due to a change in employment or retirement, the administrator must provide him with a written statement of his rights within a specified period of time. That statement tells the member the total funds in the member's account as a result of his contributions by the employer, transfers, and additional voluntary contributions. Details about the pension benefits payable to the member. Options for transfer or withdrawal. Deadline for choosing an option. 8.2 Group Retirement and Investment Plans. Group plans provide investment and retirement savings opportunities. These retirement and investment plans are available to many different types of groups, but they are associated foremost with employers. The group members are employees, which may include everyone from the top of the organization through to those at the bottom. A group plan for savings and investment, specifically to assist with retirement savings, is a valuable employment benefit. This is especially true when the employer contributes to a plan on behalf of employees. The employee's pension savings can grow faster and larger thanks to employer contributions. Also, the value of a plan can be received by a spouse in the event of death of the plan owner or a beneficiary in the absence of a spouse. Another benefit appreciated by employees is the disciplined savings aspect of payroll deductions for plan contributions. Saving by payroll deduction eliminates the temptation to spend take-home pay and save what is left over. Instead, saving is achieved by removing the contribution directly from earnings and then issuing the balance as take-home pay. There is no opportunity to spend money that is not actually received, and withdrawal restrictions on locked-in savings further prevent access to money that is slated for retirement. All members of a group plan enjoy creditor protection of their savings, except when the account is a tax-free savings account, TFSA. Membership in a group pension plan also provides a future benefit to its members through the ability to split income with a spouse. When a group member receives pension income at age 65 or older and receives the pension income tax credit, he can split the pension income with his spouse. Splitting income is an important strategy to reduce income tax. A group plan is customized to the needs and wishes of its sponsor. It chooses the most suitable type of plan and decides on the contributions and benefits according to its financial circumstances. The agent's role during the sales process is to help the sponsor identify available options and create the plan that best meets its objectives, both for the present and for the foreseeable future. When a plan already exists, it should be analyzed for suitability so that a recommendation can reflect current conditions in light of needs. 8.2.1 Existing plan. The agent may find some sponsors without any form of pension or savings plan and others whose plans no longer meet needs or align with company resources. An existing plan may not have sufficient appeal to attract the talent the company seeks, especially if a competing firm has a better group plan on offer. There may also be good reasons to supplement one plan with another, such as providing a DCPP to all group members plus a DPSP that is based on company profitability for senior executives. The agent must be prepared to analyze both the existing type of plan to provide comparisons against other similar plans and whether the benefits of the plan continue to be appropriate for its sponsor and members. Some key factors of an existing plan that are analyzed are: suitability of plan to sponsor objective, cost of plan to sponsor, investment options and their suitability for members, rate of member participation, compliance with regulators' requirements, support to members by investment provider, such as a website customized for the specific plan, and navigation that makes it easy for members to monitor and change investments. 8.2.2 Plans available. Pension plans are one of two basic types, a single employer plan or a multi-employer pension plan. MEPP. A single employer pension plan is exactly as its name describes, a pension plan for a person who works for one employer. As for the MEPP, it covers employees who work for two or more employers that are not affiliated with each other. Rules differ between jurisdictions for this type of plan. It is most commonly found in unionized work environments, and contributions to an MEPP are made on a fixed contribution basis as determined in collective bargaining. This chapter covers single employer pension plans only. Accordingly, agents who work in communities with a significant unionized workforce will want to acquaint themselves thoroughly with the MEPP rules that apply in that jurisdiction. Some group savings and investing plans, such as DBPPs, are only available through a sponsor. Other plans, such as TFSAs, are available both through sponsors and to individuals who are not enrolled in group plans. Group plans are intended to supplement personal savings, they are not a replacement. Contributions to group plans may reduce our RSP contribution room, but group members should be encouraged to save outside their group plans to build savings for the future and take advantage of tax deferral on savings. A sponsor may implement a single group plan, such as a DCPP, or various group plans. For instance, a DCPP could be combined with a GRRSP or a DPSP, to help the employer attract and retain top talent. When a member of a group plan is offered a choice of two or more investment options within the plan, he is enrolled in a form of plan known by its umbrella term, a capital accumulation plan. CAP. Therefore, DBPPs are not CAPs because the member has no investment decisions to make. However, DCPPs, PRPPs, GRRSPs, TFSAs and DPSPs are all capital accumulation plans. When a plan is a CAP, guidelines describe the rights and responsibilities of the plan sponsor, service providers such as the administrator, and members. These guidelines are standards intended to ensure that members of a CAP receive the information and assistance they need to make suitable investment decisions. CAP guidelines supplement legal requirements for pension plans. They reflect the expectations of all Canadian pension, insurance, and securities regulators. 35. As discussed previously regarding their contribution to individual savings, these same plans must be considered from the sponsor's point of view. Defined Benefit Pension Plan, DBPP. Defined Contribution Pension Plan, DCPP. Group Registered Retirement Savings Plan, GRRSP. Deferred Profit Sharing Plan, DPSP. Group Tax-Free Savings Account, TFSA. Pooled Registered Pension Plan, PRPP. Groups may also be offered a non-registered investment account. The following group plans convert registered savings into a pension income stream for group members. Group Life Income Fund, LIF, for savings created in a DCPP. Group Registered Retirement Income Fund, RRIF, for savings created in a GRRSP. It is very important for the agent to understand that a group member receives retirement income when the savings he has accumulated in his group plan are transitioned into a plan that pays a pension. One exception to this is the DBPP, in which the pension is paid by the plan directly. Other plans, such as a DCPP for example, may operate in a similar manner, accumulating savings, but many administrators require their members to take the value of contributions at retirement in a lump sum. To receive a pension and continue tax deferral, those funds are transferred to a LIF or an annuity. Both make payments, and in this way, a personal pension is created. If the retiree does not wish to start his pension, he can transfer the lump sum to a LIRA. Table 8.1, provided later in this chapter, assists in understanding plan administrator responsibilities. In the course of the transition process, there are other pension plans that an agent may encounter, such as an individual pension plan, IPP, or a supplemental executive retirement plan, SERP. These plans are beyond the scope of this manual. 8.2.2.1 Defined Benefit Pension Plan, DBPP. The gold standard of RPPs, the DBPP pays a known sum to its members at retirement. The pension income is generally determined by employment income and years of service. Contributions may be made by the sponsor alone, as noted previously, in a non-contributory plan, or by the sponsor and group plan member, a contributory plan. The sponsor is fully responsible for ensuring that funding is adequate to provide the promised pension at retirement. If contributions are insufficient or investment performance has not met expectations, the sponsor must make additional contributions to cover the shortfall. Sometimes, a sponsor is unable to meet its financial commitment to its pension plan. Such a plan is described as underfunded. If the sponsor is insolvent, it cannot be forced to fully fund a plan. In such a case, the pensioner members receive a pension less than promised. A pension plan may also have a value, due to contributions and investment returns, greater than its payment obligations. This is called a pension surplus. Sponsors are discouraged from building surpluses both by taxation of the surplus and because a company can be required by regulators or the courts to use a surplus to enhance pension benefits. A DBPP may be terminated by its sponsor or converted to a DCPP. It can also be offered in addition to a DCPP in what is called a combination or hybrid pension plan. Required contributions are made to the DBPP, but the group member can choose to increase his pension by making voluntary contributions to the DCPP. The group plan member has no investment choices to make when he is enrolled in a DBPP. All investment decisions are made by the sponsor and/or administrator. The sponsor's contributions are a tax-deductible expense and are not a taxable benefit to the plan member. When income begins in retirement, it is paid as a joint and last survivor annuity for the member. And, upon his death, to his spouse, although the pension received by the spouse is typically a reduced amount. A sponsor may choose to index payments to increases in the cost of living. Doing so affects plan pricing for the sponsor. DBPPs were once the most common form of pension plan. This is no longer the case because some employers have recognized the significant ongoing financial commitment to the corporation created by pension contributions. This expense has been exacerbated by lower pension fund returns as a result of low interest rates coupled with increasing lifespans. The low returns in the funds and pension income that is paid for a longer period of time mean that sponsors are being required to make up shortfalls by special contributions between pension fund value and obligations. Many have taken advantage of their right to switch their DBPP to another form of pension that is less expensive, such as a DCPP. Example: lifespans in Canada are on the rise, and this creates pressure on the sponsors of DBPPs who are committed to providing a pension for life for their plan members. For instance, the Ontario Teachers' Pension Plan is a well-funded DBP that provides generous benefits to its members, teachers in Ontario. It reported that, in 1990, the plan had 13 pensioners aged 100 or more. In 2020, there were 147. In 1990, the plan expected a pensioner to receive his pension for 25 years. In 2020, the expected years on pension were 32. This illustrates the increasing financial pressure on a plan as a result of longer lifespans. 8.2.2.2 Defined Contribution Pension Plan, DCPP. A DCPP is also known as a Money Purchase Plan, MPP. A DCPP does not create the same financial pressure on its sponsor as a DBPP for the simple reason that no set pension income is promised to members of a DCPP, so the sponsor is not responsible if a shortfall occurs. The member's pension is a result of the amount of contributions made, how long contributions are made, the choice of investments, and the performance of the selected investments. DCPPs are gaining market share over DBPPs because of their reduced financial obligation on the sponsor. Some DBPPs are being converted to DCPPs and more sponsors are choosing to introduce a DCPP over a DBPP. This trend is likely to continue since many pension plan sponsors do not want to be responsible for pension fund returns and the fact that plan obligation values increase as lifespans increase, as occurs with DBPPs. DCPP sponsors need not be concerned about investment returns or longevity of members. They set up a plan, make their specified contribution to the plan, and ensure ongoing compliance with regulators. The administrator of a DCPP is responsible for educating all plan members about the details of